Everyone, to the Money Mindset Mastery podcast, where I'm your host, Jim. Joining me today, as always, is my co-host, Ryan Janelle. Ryan, how are you today?
Good day in Toronto, although people are kind of sad after the Blue Jay loss, but we have some hockey. Hockey's back in town, I guess, now that we can be focused on
Yeah,
that.
yeah. And today we have our guest. We haven't seen him in a while. It seems like forever. Portfolio manager at TVH Wealth, Denis Bisson. Denis, how are you today?
I'm doing fine, and it has been a while, so glad to be back.
Yeah, how does it feel? A little rusty today? Or you gonna
We'll
be you
see.
gonna be okay?
I hope not, but we'll see.
Yeah. Well, the reason why we had you join us today is because you recently wrote a blog post. So that's been a few months since you had one out there, and it's a topic that's really come up a lot recently. What I'll say is, first of all, if you're interested in the blog post, it's all about what a person should do if they leave an employer and they have a pension plan, specifically a defined benefit pension plan, and what their options are. And most people kind of default to just keeping it where it is and getting the guaranteed income, but that might not be the right solution for everyone. So if you're looking for the blog post, you can go to tvhwealth.ca, and it'll be the most recent one that's on there. You can also find it at tvhgroup.ca and tvhfinancial.ca. So, Denis, why don't you kind of get into it in terms of the blog post, why you wrote it, and why people may want to consider different options?
Okay, so the reason I wrote it, as you know, you mentioned I'm a portfolio manager, but I'm also a certified financial planner. So I will get asked this from clients on what to do. And it's really, you have to go through the details. There's no straight answer without knowing the background details on it. I had somebody that worked at a firm that for a fair amount of time, but the pension was small. So we looked at the amount, and it was like 200 to 300 per month, and they said that's not even worth it. So it was a transfer, and it was a reasonable size transfer, just under 200, and it was reasonable size. So we just invested it because we thought we could definitely do better than that. That when this person retires, to get a better monthly income to start. And given her situation, it was the right thing to do. Didn't really want any connections and from a company now. It's probably 3 companies ago, and having to deal with that and a small amount. So now full control. Now they have it, and they're moving forward. But that doesn't work for everybody, and there's reasons why it doesn't work for everybody, and we'll get to that a little more. Why I wrote the blog is that here are the options, and here's what you need to look at before you make that decision about transferring it or leaving it. So even some of the emotional decisions, I want nothing to do with that company, I'm just transferring it out. But you still have to go through the details, and you want to make a more clear decision before you make that choice.
Right. Well, and Ryan, you're working on a situation right now because, and we're not going to be disclosing names or anything, but it's kind of like the opposite, right? Where there's some people who have worked for their company for 30 plus years, and they don't understand what the value of the pension really is. So that's called the commuted value. And there's a lack of understanding of what happens at death to the balance of that pension and the value of that pension. So, Ryan, do you want to maybe share kind of like the opposite example you're currently working on, once again, without sharing any specific details?
Yeah, obviously, so as Denis was saying, obviously people have an option one, which is to leave it with their former employer, which, as you said, can be a very emotional decision of either you just want to leave that company, no strings attached, otherwise commuting the value. And I think through this situation and a lot of situations that we've talked about really over the last probably year or so is we run to a lot of situations where people don't even know that they have that option of commuting it. And I think that's probably one of the big discussions. But there's a lot of questions. Obviously, that's why we have Denis here today. A lot of questions is, what does that look like? What does the commuted value look like, and what and how can potentially a different option give you more choices? And I think the more that I've talked to a lot of clients over the last year is, one, not even thinking that this wasn't even an option to commute this, because there's a lot of other little things in the background that people may not have considered. And again, it's something that we would talk through with every client, is asking, what's your ultimate goal with this? And, you know, who are the beneficiaries? And, how is this policy, or how is this a pension built for you? And does it meet your longer term goals? And I think having Denis on here will help open up the conversation with a lot of people. Again, we always say, for us here, it's about education, right? Knowing that there are options besides keeping it in the current pension. Again, some people have some very strong pensions, which we would obviously look at not necessarily recommending, but at least we're providing some context to people and some education about, hey, this might be a good option for them. So
Yeah, and I think before we kind of get continue on with this, we want people to understand that none of what we're talking about today should be taken as advice or financial advice on your pension or any other investments that you hold, because everyone's situation is unique and different, and what their goals are, right? So, what I would suggest is, based on what we talk about today, if you have any questions and you want to reach out to us and schedule an appointment, feel free to do that. You can reach out to us through the comment sections of any of these social media accounts that we're sharing this on. You can also reach us at financial@tvhgroup.ca, or you can reach Denis directly at tvhwealth.ca as well on his website. So I did say something earlier that I need to correct myself, where I said that the pension income is guaranteed. That, I believe, actually is the first misconception, right? And I said it because, again, this is what we've been told. But the bottom line is pensions are not guaranteed, right? So, Denis, can you maybe speak to, let's talk about private pensions right now, then we can talk about the public, because the public pension is a little bit different, but maybe about private pensions and why they're not actually guaranteed pensions and how they're funded.
Yeah, well, I think I mentioned that in my blog as well. If it's a company pension, the first thing you want to look at is this company strong? Is it a fully funded pension? Is that pension going to be there if you say left at 50 and then start collecting at 60 or 65? That's one thing you have to look at. The most public example of that was the Nortel pension, and how people are struggling to get their money out of there, and they're not getting what they were promised, and it's going to be a fraction of that. Now, Nortel's not everywhere, but there's a lot of small companies out there, and you need to ask the questions. Is it fully funded? There's been numerous plant closures of small companies in Ontario lately. You really have to look at that. Not only your own situation, but first of all, is it an option to keep it at the company? Because you may not, that pension may not even be there, so you might as well pull it out while you can. Again, that's more the private company. Public company, that's not really an issue. Then you look at the other factors as well. But that's definitely one thing you have to look at if it's a private company pension. Is it fully funded? Will it be there when you start collecting? And can it pay you for your entire retirement?
Yeah, and I mean, you used Nortel as an example, which was an extreme example.
Yeah.
But I'll be honest with you, in 2008, when we dealt with the global market meltdown, GM pensioners, for example, were at risk of having their pension income cut in half, right? But there was a government bailout that happened. In addition to that, we had companies like Simpsons and Sears over the years. These were once
Yeah.
established
The
large blue
pay.
chip
Yeah.
companies, right? The Bay, the same thing, right? So it's not just the extremes like the Nortels. There have been other situations in the past where not only were the people who hadn't retired at risk of not receiving the pension that they were told they would receive, but the actual employees or former employees that were receiving pension income were at risk of having their income actually cut as well, right?
Yeah. Yeah.
Um, and usually, like, there is a way to determine if a pension, if there's a shortfall, and that's something that I've seen fairly recently, I'd say in the last 5 or 7 years, that's now reportable, right, to individuals. And a lot of times I'll see things like this pension is like 73% funded, meaning they don't have the 100% that they need to fully pay out everybody as they intended or hope so, right? Or hope for. So, first thing to clear up, pensions, private pensions are not guaranteed. There could be a shortfall, and anything can cause a shortfall. On the public side, um, they're not really technically guaranteed. However, if there's a shortfall, the government just increases taxes and make up the shortfall, right? So they're not necessarily guaranteed, but they kind of are guaranteed because they're just going to take more money out of our paychecks to cover off those shortfalls.
They also make current employees pay a little more as well to cover that. If I did some taxes where teachers were involved, and they're paying between 10 and 12% of their pay into the pension. That is a large amount of your pay going into the pension. So they get a very decent pension, but they are paying into it. So, but if you read an article a few years back, they were saying they had numerous teachers nearing the age 100. So they're collecting a pension longer than they were actually teaching. So these things are very difficult to keep funded, especially the more people that get added on to it. And right now, if people are going to live longer, and it's the current employees that are going to start paying a little higher.
Right. So Ryan, there are people that love the income that they're receiving that they can count on for the most part from these pensions, right? The negative side is also that they're not liquid. So whatever the amount is, that's what you're getting. You can't really tap into extra cash from your pension plan. So one of the things that you and I typically recommend when we're looking at strategizing in terms of accessing the different buckets, so to speak, right, from funds, usually we say start off with the e-liquid income sources first, because we can't control those, right? So things like Canada Pension Plan, Old Age Security, and your work pension. And then we start going to the most liquid, right, after the fact. But what are the main concerns with someone who finds out what the commuted value is, right? And I've personally witnessed clients who have worked, with pensions of community values of over 1.5 to $2 million. Like, it's significant, right? But one of the negative things is what happens to the pension income, A, if you do have a surviving spouse, and B, when that surviving spouse passes away. Does that balance of whatever is left over get paid to your children, grandchildren, or any of the other beneficiaries?
Well, and so that's essentially what the concern comes down to for a lot of people is, if you have a pension with a company, it stops depending on how the pension's built. And we often go through this with a lot of clients is help them understand long before retirement, what's going to happen when you retire. And some pension companies have a 10-year or sometimes a lifetime. Some are in between. Again, it's all in the details, and that's what we try to go through with clients. But I think one of the big things that comes up is what happens when I want to pass on legacy to the next generation, right? Not only my kids, but my grandkids. And for some people that have worked 25, 40, 50 years for a company, that pension will stop at your spouse. Sometimes you, and sometimes your spouse. So it's very important that people look into these things, 10 or 15 years out from retirement to know, does my spouse even get part of my pension? Part, some, all? And does my family? I just worked 50 years for a company and nobody's getting anything past that. So that's where the dialogue starts to change and where we come into asking more questions about people's goals, asking questions about, their longevity, what their ultimate outcome they would like to see happen. And that's where really over the last year, especially, I've seen more and more conversations with people starting to talk about wanting to potentially commute their pension because it gives them control over it versus that 50 years worth of work now going back into a pension that, they worked so hard for. So
goes back to the company, right? And the remaining surviving pensioners. So we're going to talk about what commuted value really means. But in all the years that I've been helping clients transfer their commuted value into another option or helping them make a decision on what they should do with their pension, I would say that the majority, and when I'm talking majority, like I don't have definitive numbers, but 95% plus had some kind of survivor option to a spouse. So there's been very few and far between in pensions where that wasn't an option. And I only can recall one time in the 30 plus years that I've been doing this where there was a term certain payout, meaning that if the individual passed away before the 10-year mark, uh, then there would be like a balance would be paid out to another beneficiary. I've never
Mm.
seen that anywhere else. So the majority of them seem to be you receive your pension, there's a survivor option, then after that it's done, right?
Yeah.
And that's where we're starting to highlight to individuals, and people are starting to see these statements. They're asking the question, well, what's this big number over here? What does that commuted value mean? So Denis, maybe you can speak to what is a commuted value.
Yeah, and just to go back, I have seen that on some BC public pension plans, on some terms certain, and then after it's no longer, especially when it comes to pay the spouse. So the commuted value is in a lot of cases, it's the present day value of what the pension is, not future value, present day value. So there's a discount rate. They say if we were going to pay somebody a certain amount for this many years, how much money would we need now up until a certain point? Looking at the contributions, of course, if you did a lot of, if you paid into your defined benefit, which some cases, in a lot of cases they do, like I mentioned, the teachers and other pensions I've heard of as well, that will take into account at the same time. So the future value then becomes your responsibility. So you're really getting a value as of today of what everything, whether you put into it, what you gain, your from how long you worked there and everything else, years worked, and that's what you're going to get a value of. So some people think it's a high number. It can be a very high number, but if you put in and you're probably a little more the executive side for depending on or you work there a long time, that's when you're going to get the bigger numbers, especially if it's a combination of you contributed, your salary is very high, you were promised this as part of even your employment package, which in a lot of cases it is. So that's that value that you're going to see. Sometimes it seems high and people just want to take it, but again, go through the details. And we mentioned before, which I'm sure we're going to touch on before, single people, whether separated, divorced, never been married, widowed, should be looking at this differently than a married spouse, where the spouse can get 50 to 60% if they go first.
Why should they look at it differently?
Well, that's when if you're single, then there is no beneficiary afterwards. You get paid. Nobody's gonna. If you pass away, it ends. If you're supporting kids at the same time, yes, it's going to be taxed on your tax. That commuted value is going to be taxed, but at least you're leaving your kids something. Especially if they're close to, maybe not out of the house yet, or even younger than that. That you do want to leave them something.
Well, I'm going to disagree with you there, because just because you're single, it doesn't mean you don't have loved ones that you'd like to benefit from that asset.
Well, that's what I'm saying. The beneficiaries, the ones you want to leave it to.
Yeah, but even on, so married or not married, right? I think if you stay within the pension plan, in both cases, there's going to be an end date, right? The spouse passes away. So even if you pass away as a pension income earner, you're married, and it rolls over to the spouse at 60% or a reduced amount, right? If you're in the pension after that death, second death, there's nothing else to be paid.
Correct.
Right. And if you have children or grandchildren in that situation, you may want to continue on passing on that legacy to the next generation. If you're single and you don't have any children, you might have nieces, nephews, right? So again, you might look at that in a different way as well.
Yeah.
So I don't think it's really the stage in life that people need to focus on in making this decision. I think it's more about what guarantees do you want? What certainties do you want? What level of control do you want? Or I know I've said this to Ryan before, when you're in the grave, how far out of the coffin do you want your arm to reach out, right? I think that's where it comes from, but that's my personal opinion.
Yeah, it's always the full picture. Everybody's going to be different. And the other case is, sadly, if you're, on the verge of retiring and you got the option of taking the commuted pension and you're not that healthy, maybe you do want to take the full money out now because you know you're not going to be collecting for that long. There's a lot of cases where people have cancer early or just, had a heart attack already before they're 50. And I know people that have passed away at that age for heart problems. So if you're looking at that and you're not going to be living, you don't think you're going to be living till 90 or even till 70, then you may want to look at a different option just to make sure that you're leaving something, whether it's a spouse or whether it's kids or whoever your beneficiary of your liking is going to be. At least you'll be able to, and you have full flexibility on it. And I like the fact you said on liquidity as well, you need a little extra. Well, sometimes you can take, it's not just a minimum. You could take a little more than the minimum. There's, of course, in a locked-in pension, if you're taking the commuted value, there's a minimum and a maximum. You cannot just cash it in afterwards. I think we should let people know that as well. You will have to treat it as a LIF, which is the locked-in version of a RIF, and not just be able to cash it in. There are options at retirement. When you transfer it to a LIF, you could put 50% in a RIF, where that's full flexibility on that 50% of the account. But you got to look at all those options, especially the unlocking part. A lot of people forget about the unlocking part.
Yeah, there's a tax liability with unlocking some of the funds as well, and we can get into that at some point. What I'm going to do is, Denis, I'm going to ask this question of you as a portfolio manager, and then ask a follow-up to Ryan. But before I say that, what I would say is this, is that once upon a time, I know when I started 36 years ago, most pension plans were defined benefit pension plans. Something like 82% of pension plans in Canada were a defined benefit pension plan. Now I believe the number is like under 50%, like it's in the 46, 47% range, because defined benefit pension plans are costly. And the reason why they're costly is if there is a shortfall to fund the pension, it is, generally speaking, the responsibility of the pension trustee or the company to cover the shortfall, to maintain what they're promising to pay, right? So a lot of companies have now transitioned from a defined benefit, where you know what your income is projected to be, to a defined contribution. So that's taken the pressure off of the employers now and the pension managers, because it's basically, here's how much you're going to contribute every single month or every single year, and whatever that turns into, based on a rate of return, your contributions, then that's what it is, right? There's just projections, but it's not guaranteed.
Yeah.
But what I'll say, Denis, is we're talking about commuted value. We're talking about options, right? Other options aside from keeping the pension where it is. So as a portfolio manager, if someone decided that, I don't want to keep my pension where it is, I don't want that income coming from my former employer, I want to take the commuted value, what are their options? What are you recommending to clients as a potential option?
If they want the money out and transfer it to a locked-in plan, that's when we start looking at the just setting up a portfolio for them, a risk level. You want something similar. You don't want to be, from my point of view, this is pension money, and you want it to last. So you want a good portfolio, not aggressive and not too conservative as well. You want to at least be past that inflation point. So you want a good portfolio. Depending on the age, balance to balance growth, for the most part, I would recommend. We got to look at the full picture, though. Do they have anything else? For some people who want to keep the defined benefit, they have nothing else. So they need that guaranteed income. Otherwise, they may be in trouble, hit the poorhouse when they're retired. So if they have other income and like they have their max TFSA, they may have an RSP, then you start looking at potentially maybe being more, I wouldn't say aggressive, but more on that balanced growth side. Balance is more stable, and it depends on your risk level and what you can take. That's the usual option, but balanced growth is an option for quite a few people as well, including myself.
Yeah, so I'm not really talking about what risk should they be taken. I'm just more talking about your recommendation would be to transfer the commuted value into a portfolio, a liquid portfolio.
Yeah.
regardless of the risk profile, because that's different based on the individual, right? But your recommendation is, okay, well, let's move the commuted value over into a core and explore potential option. That's something that we talk about at Raintree, right? So that's an option. What's the positive to making that move, and what are the negatives? What would someone be gaining in moving the funds over to a locked-in account, and what are they giving up if they did that with you?
Well, one, they're giving up, as we mentioned before, the guaranteed income. When you move it over to a portfolio, you can actually gain more than you would have on the pension if it's invested properly and it's a long-term period. And the last few years have been just, I wouldn't say unusual, but we've had some strong markets the last few years. So you're seeing some nice gains, even on a balanced conservative portfolio. You're seeing near double digits returns. These are the positive. You have full flexibility. If you unlock 50%, you could even take some money out. This is the key on when you're commuting it. But again, you use that supposedly guaranteed income, depending where the pension is coming from. But you have full flexibility. You have flexibility in the beneficiaries. You have flexibility about potentially taking money out if needed in an emergency. This is what the positive side is from the commuted. And because, and if you're married, if you have a spouse, it's actually set up by the legislation that your spouse is your beneficiary if you have a spouse. So that you can't change. So I always tell people to keep that in mind as well. But at the same time, yes, she gets it, and it depends on who passes first. It can easily be transferred tax-free to the spouse if you were to go first. If she were to go first, then you're looking at potentially kids or other beneficiaries. But somebody will get the funds. Doesn't disappear.
Okay, so the positive is potentially better performance than a pension because of the way pensions are structured, right? Some liquidity, more so than you would have if you've left it in the pension plan. Mm-hmm. And the fact that you can not only pass it over to a surviving spouse, but to the next generation. So a payout would continue on. So those are some of the positives.
Yeah, right? And it's not 60%. You're transferring the entire account over to the spouse if you were to go first and you're the holder of the locked-in plan.
Correct. But the negative side is because there's no guarantees in the income that an individual will be receiving because they're taking on market risk. Mm-hmm. There's going to be fluctuations. The portfolio is not guaranteed any source of income. So in terms of that certainty and stability, that's what someone would be giving up if they did move their commuted value over to a portfolio.
And that's why and that's why when somebody is a little hesitant, they'll pick just the balance. They don't want to take that extra risk and for the more stability of the returns.
Well, the returns are stable, but again, there's no guarantee.
Still, no. Never any guarantees when you're invested in the market.
Yeah, exactly. So I think that we have to stress that, right? So then, Ryan, what do you and I typically recommend for clients who say, you know what, I don't want to leave it in the pension. I do want to take the commuted value. Now, I don't want you to name products specifically, all right? But just to kind of some of the types of assets that we use. But client says, Ryan, Jim, I don't want to keep it in the pension plan, but I really love the guarantee income. I want to have the flexibility to have guaranteed income to be paid out to my spouse if I pass away, and for money then to also be paid to my children and or grandchildren, because I've worked at the company for 35, 40 years, and I don't want to leave anything to them behind because I've given them my blood and soul, right? So is there an option that would mirror the guaranteed income that the pension would receive, but also provide the benefit of the liquidity and the passing on the funds to the next generation?
Yeah, well, absolutely. And again, we would go through a number of questions, their risk, their outcomes they want, just to clarify every step of the way, because what we often talk to clients about is about layering in things. So maybe a portion would go to a portfolio manager, but that guaranteed lock-in, yeah, we have a couple options that people could look at as guaranteed income. Again, not putting any particular companies out there, but there are some companies, particularly that we have worked with, that can offer different sources of guaranteed income, and a lot of the times we're offered through insurance companies. That's the one thing that we would look at. But taking all things in consideration, what is somebody's risk tolerance, and obviously the person that wants that guaranteed income, there are ways to create kind of your own type of pension outside of the pension, with the positive of the money going to the family members after, or the benefactors that you wanted in the end, very much like a pension does, but with some added bonuses, being able to name more than just your spouse as a benefactor. So,
Right.
yeah. And I
just go ahead, Ryan.
Well, I was going to say there's other things that we very much talk about, and we've talked about it on previous episodes too. Sequence of returns is another big thing that comes into conversation. And if you haven't, please go back and watch. Otherwise, Jim, I'm sure you can touch upon sequence of returns very quickly for people. But something that I was just thinking about through this is something people need to understand is, if you've already started collecting your pension, this is something you need to talk to somebody else about, because if you've already started collecting, unfortunately we can't, but if you know people that are coming up to retirement that are going to make this decision, I think it's very important to mention that is, if you've already started collecting your pension,
nothing can be done.
This is all education for you for your next life, or potentially sharing this information with somebody else. Perhaps a spouse is a couple of years away still from retirement. This is where all these conversations start happening. So,
yeah, no, that's a really good point. And I think the other thing we need to make clear with a lot of individuals too is, the negative side with leaving it within the pension company, as we talked about so far, is, again, you can have a survivor benefit, but then after that, there's nothing there. However, if you take the commuted value, you roll it over into a locked-in account, and it gets transferred over at death to the surviving spouse without any tax to the surviving spouse. But then when the surviving spouse passes away, whoever they've named as beneficiaries, whatever the balance of that locked-in account is, would be fully taxable, right? So that is a negative side to it, but at least they're getting something instead of nothing at all, right? So, for example, if there was $500,000 left over in that locked-in account on the second death, and you leave your child, children, grandchildren, whoever as beneficiaries, a lot of that 500,000, approximately half of it would go to CRA and taxes, and your beneficiaries would receive $250,000. It's still better than nothing, right? Because option one, there's nothing. Option two, there's something, right? So I just wanted to make that clear as well. Denis, anything else that you want to kind of mention based on this decision? Because a lot of people are facing this decision. They automatically default to, hey, I know what my pension is, and that's what I'm going to stick with, without really considering what other options are. So is there anything else that we're missing out here that we should share or talk about with people?
No, I think the key is every package is different. Whether you left on your own, got laid off, terminated, whatever the reason, you get a package, read the details, see what your options are, see what look, is there a potential if you stay there, does your wife potentially get something, or a husband or a partner? That's the key on here. It's just read the details. Then you have to look at your own situation. And the best thing to do is to talk to an advisor. Go through it with them to see potentially what's best for you. The answer is not always commuting the pension, especially on the government pension. The answer could be leaving it there, but if it's again, not guaranteed, but if it's a public pension and you are going to get it, it may be that best option, for you and your family.
Well, what I would say is this: we don't edit our episodes, so I'm going to correct you live here on this one.
There we
So
go.
don't go to an advisor; come to us. And the reason why I say that, and I'm not trying to be cheeky here, but the reason why I say that is if you go to, for an example, an advisor who is mutual fund license only, they're going to only recommend a mutual fund portfolio. And if you want some of those guarantees, if you want your money managed like a pension plan, but not in the pension plan, you're not going to get that from a mutual fund advisor. If you take it to the bank, and Denis, you and I are former bankers, what are we going to recommend, or what would we have recommended as former bankers? Mutual funds that are available at the bank, right? So the reason why I'm saying this is to come to a firm like ours is we are multi-licensed. So if you go to an insurance advisor and that's all they offer, guess what they're going to recommend? They're probably going to offer you some guaranteed solution, and maybe that's not what you want, right? You want a little bit more flexibility instead of the guarantees, right? So come to TVH Group, go to TVH Wealth, come to TVH Financial, speak with us, because we don't hold one single license. We are a multidisciplinary firm. We are a family office. We are not restricted in terms of what we can offer you as a solution. So we can provide you with that unbiased advice to say, you want the guarantee, we have that for you. You don't want the guarantee, we have something different for you. Right? We can meet whatever their goals are. Right. So are you okay with me correcting you there, Denis, on that one?
Yes, more than okay on that one.
Okay. And I'm going to add something else, only because we had our meeting today, and we have our weekly meetings where we talk about each other face to face and just see to make sure that we're catching everything, because we all want the best interests of the clients. And when we're seeing it from different perspectives, sometimes there's some big client cases that we talk about, and we're, with obviously the permission of the clients, that we're sharing the information. Okay. But we're able to bring in an accountant. We're able to talk to you, Denis, as the portfolio manager. We're able to bring in insurance ideas. We bring these ideas and talk and walk through them. It's not just one individual that is potentially missing out. And that's what we're seeing more and more often is, as you said, Jim, one person's holding a single license that's not talking to other people, that's assuming that they know everything in the world that they could know about helping somebody. But when you have 3 or 4 brains going at a client's case to be able to make sure that we're doing what's best in the clients, I feel like that speaks a lot about like how we can kind of go back and forth and not agree with each other, but ultimately we're seeking the best option for the client at that time. So
yeah, and I'm famous for my analogies. I like using my analogies, and the one that I've been working on recently is, if you are shopping for a V8 pickup truck that can tow 10,000 pounds, and you go to an auto mall, chances are you're going to find a few of those options between different providers. If you go to Honda, as an example, and you say, I want a V8 4x4 pickup truck that can tow 10,000 pounds, they're going to say, you know what? We don't have quite something like that, but we have the Ridgeline. It is a pickup truck. It can't tow 10,000 pounds, but it is a pickup truck, and it's a V6. And here's why you should buy that. And they'll try to fit you into what they have as an offering. We're the auto mall, if we're going to say, and I love cars, so that's why I'm using the car as the analogy right now. But we're the auto mall. You come to the auto mall and you tell us, this is what I want. We will find the solution because we have access to the inventory. We have access to the solution. You go to a specific dealer, chances are they're not going to have what you actually need, and they will make you feel like what they have is what you actually need, right? So I just wanted to use that as the example because I don't know. I think it's time for me to get another car, but anyways, we'll leave that alone. So, guys, anything else before we wind things up? No, Ryan?
No, I'm good.
Again, as Denis said, like, if you've left your job or quit or decided to find other pastures, or you're coming to retirement, really this decision is not easy. And a lot of people kind of try the easy way and kind of go fly by the seat by their pants, which is often the dark horse of the things that end up making things not so easy in the longer run. And I would say, like, the right choice is really talking to trusted advisors like ourselves to help really talk through what your goals are, and to make sure that it's personalized and you're not just cookie cuttered, like the last 10,000 people that walk through the door of a certain institution. So let's run the numbers together is really what it is, and find out what the best way for you and your family or your business. So
Yeah. And there's a reason why when you receive the package, because you and I and Denis, the three of us, we always ask for clients to send the package to us so we can review it. There's a reason why the first option is the default option, which is take the pension income, because they want you to keep it in the pension, because they're hoping that you're going to die sooner and they're going to absorb those funds to continue on funding the pension, right? That's the reason why that's the default as a number one option. So talk to us. We'll go through the various options, talk about the positive and negatives of each one so you fully understand and you're educated before you ultimately sign off on whatever option you decide to go through. So um, Denis, thank you very much for writing the blog post. This is again, this has come up a lot recently for sure. I'm seeing a lot more of it too on social media, people talking about it. So Ryan and I appreciate you writing the blog post. And again, if anyone has any questions, reach out to us. Find Denis at tvhwealth.ca. Find the rest of us at tvhgroup.ca. Look at all of our social media accounts. We're on LinkedIn, Facebook, Twitter, TikTok, YouTube, obviously, and also on our podcast. And if you want to reach out to us directly, financial at tvhgroup.ca or 647-727-4668. Guys, have a wonderful afternoon.